The first quarter of 2018 was the most dramatic quarter we have had since the euro area crisis. We went from euphoria and 5% return in global equities, high inflation expectations and growth expectations, to a big hiccup in volatility where we saw that selling volatility was the most overcrowded strategy in financial markets. Inflation expectations have come down again. Rates are still being hiked by a confident Fed. We have had a hiccup in the technology sector, seeing a 10% decline over a data scandal at Facebook and increased uncertainty over regulation in the technology sector. We think Q2 is going to be quite flat, so to speak. We have macro data surprising to the downside. We have gone from a 8-year high on macro against expectations to almost a 5-year low against expectations. And right now, macro data is doing significantly worse than expected. We think growth is going to slow down here in Q2. At the same time, there will be an increased negative sentiment around the technology sector. We know that earnings will be good. It's mainly due to we have seen past good economic growth, but it's not about revenue and earnings in Q1, it's about the outlook, and we think that companies will strike a more cautious tone going into Q2. We have an escalation between the US and China on the trade war. We also have Russia and the US seeing increased tensions over the events happening in Syria. And if you add it all up, we would not be surprised to see a disappointing Q2 for equity investors. The key risk here is obviously the trade war between the US and China that could really take the economy down in terms of activity levels. If we get global equity markets printing lows below the lows we saw in February, that would be a big danger signal. If you look at our asset allocation model, it's clearly sending defensive signals to investors. This is not the time to be aggressive in equities, and that's our stance here in Q2. You should be defensive. Don't be all in on equities. And if you want to have exposure to equities, think about it being smart. Do the defensive sectors like healthcare and consumer staples, even utilities and telecom, as we think that rate expectations could cut down as well.